Hi everyone, my name's Rhys Adnams and I'm the founder and CEO of Eaton Square. Today I'm joined by Stefan Schaefer, who leads our debt business out of New York in the States. And we thought it'd be helpful to give you a quick update on how we see the market. So Stefan, how would you describe the current market in the US at the moment?
Thanks, Rhys. I'm glad to join this evening. I think the market's about as good as it's been in a long time. The Q4 in the private market in the US was a very, very difficult time. It wasn't because of liquidity constraints, and it necessarily wasn't because of COVID exclusively. But there was so much work that COVID deferred. Deals that should have been done in the first quarter got pushed to the second quarter. Deals in the second and third quarter got pushed to the fourth quarter. So it was really a mad race to close deals in the fourth quarter. So human resources time was at a real premium. But liquidity conditions underlying that were very, very strong. So we go into the new year with all of those liquidity conditions, which were beneficial, but with people with a lot more time and willing to dedicate to the market. So it's a very good time. Specifically, SPP has lowered its pricing pretty much across the board going into the new year and expanded our leverage tolerances, representing the fact that we think it's a much more forgiving market for issuers right now.
Oh, cool. So how would you describe the demographics of the lending community then? So who specifically is doing what in the market?
Yeah. I think what we're seeing is a continuation of the trend that started, a number of years ago and continues to grow. And that really is replacing commercial banks as the primary source of liquidity in the market to the direct lending and private debt funds. Private debt funds have grown from 300 billion in 2010 to 845 billion in 2020. We expect them to go to about 1.4 trillion by 2025. I mean, so much capital has been raised in the private debt asset class that all that money is in the market and competing with banks and creating a little bit of disintermediation of the traditional banking relationship. And when you disintermediate that banking really component of the market, you also disintermediate a part of the subordinated debt market, because very often when you achieve a highly leveraged deal 4 times, 5 times, a bank will be part of that, and then you'll have a sub-debt provider being the other component of it. And with the non-bank lenders, very often it's more of a unitranche product where one lender is providing the senior and the sub all in one instrument through a unitranche, getting leverage up to 5 times with a single lender.
So does that mean your deal structuring is getting, I won't say complicated, but more sophisticated for customers?
I don't think it's more sophisticated. I think it's really more efficient. I think what's happening is that bank pricing and the commercial bank market is still there. It's not going anywhere. It's still the lowest cost of capital. Asset-based lending ranges from LIBOR 1 to LIBOR 3. Cash flow pricing in the bank market is LIBOR 3 to sort of LIBOR 4.5. So it's still very competitive pricing. The non-bank market, direct lending market, really pricing starts at about LIBOR 5 and it goes up to about LIBOR 9. So you're paying a premium to go into a direct lender, but in exchange for that higher pricing, you're getting looser covenant packages as a general proposition, where banks are going to be pretty difficult for them to get above 3 times leverage on the senior side. A non-bank lender will go up to 5 times. Now, again, it would depend on the credit and and the nature of the transaction itself, but and pricing will impact that as well, of course. But we're talking about leverage with a single lender as opposed to a bank which is cut off at 3, someone going 5.5 times. Banks are going to require amortization structures which are at most aggressive, maybe 4.5%, but usually closer to 7 to 10%, and as high as 15% per annum. A non-bank direct lender leverage amortization begins at sort of 1% and goes to maybe 5%. So it's a much easier debt service component to do it, and then there's also just an ease of execution component. With one lender providing 4 times turns of capital as opposed to a bank combined with a subordinated debt lender, you don't have any intercreditor agreements. You have one straight agreement, and it's a little bit quicker. And of course, the non-bank community doesn't have the Fed, the FDIC, and the OCC, providing guidelines on leverage and amortization and all the other things that go into a commercial bank deal. So banks are still a great source of capital, and they're not going anywhere. they're being forced to be a little bit more competitive just because of the amount of capital that's come into the direct lending community on a private basis.
Yep. Okay. No, that's good. And lastly, we have a new president and new administration. Putting your fortune teller hat on, how can you see their new policies and the next round of stimulus impacting lending over the next 12 months?
Well, I think it's all good news. I think everybody's looking at a couple things are combining at the same time. I mean, the most important thing is the Biden administration has noted that it's looking for a $1.9 trillion, stimulus package, and that's going to go a long way for companies that have also been negatively impacted by COVID. There's going to be a new round of PPP, the Payroll Protection Program. So there's a lot more, I think, just spending that's going to help the market in general. We're going to get a GDP for Q4 of 2020. The Atlanta Fed is projecting 7.4%. We haven't seen 7% type growth rates in a long time in this country. Even if that's optimistic, even if it's something closer to 4.5% or 5.5%, that's still robust growth. And robust growth in GDP tends to translate into robust growth in EBITDA. And accordingly, it's going to be with higher growth in EBITDA. That means more people may think about the M&A market and selling their businesses. And I think the other thing that's happened is that if you look at what we've gone through the pandemic, whereas in 2008, 2009, when we had the recession, it was so profound that there were a lot of covenant breaches like there were like they were this time around. But those covenant breaches often resulted in bankruptcies. Today, because of the leniency that the banks showed at the beginning of the COVID crisis, because of the Main Street Lending Program, the PPP, this more forgiving atmosphere in the country, even though we've had a fair amount of breaches and covenant defaults, through the COVID period, going into the new year, we're not seeing those translate into bankruptcies. Actually, bankruptcies are less than 25% of what they were during the Great Recession during that same period. So I think everybody's very, very optimistic, and that optimism is right now translating into better leverage because people will give you a little bit more leverage if they think EBITDA is going to go up. Obviously, if they're thinking about EBITDA reductions and contractions, they're going to be a little bit more concerned about providing extra leverage. And by the same token, because there's so much capital, there's a lot of competition, and that competition is going to result in some pricing compression. So all in all, it's a very, very good time.
Yep. Excellent. Well, thanks for your time today, Stefan. And it looks like it's going to be a nice, busy year. Thanks again.
Well, we're looking forward to it. Thanks.